analyst at City Index. And look, let's not beat around the bush. It's a pretty gnarly day out there, very, very volatile. I'm sure a few people are a bit nervous about what they're seeing in the markets right now. Just want to go and have a touch upon that to go and kick off with. Also have a look at what's going on when it comes to Fed rate pricing. We're seeing a big move at the front end of the US curve based around this apparent fear of a hard landing in the United States. Then look at ahead tonight's payrolls report in the United States, which will be very, very important in the context of what we're talking about today. Then I want to go through briefly, have a look at the RBA meeting next week, and then look at some of the technicals that we're getting from both the currency markets and equity indices futures, which to me are being much more influential on the actual story itself. I think the narrative is being built to fit around what the price action is telling us right now. Look, just to go and kick off with, let's talk about today, and let's talk about what happened last night. Big reversal following that rally following the Fed. Not unusual. We see a lot of reversals of Fed moves the next day after, so it's not really that unusual. And the catalyst that people are pointing to is that ISM manufacturing now circling to 46.8, so no, two points below what it was previously. Look, it's not a great indicator. When you talk about the manufacturing sector, it's a very, very small part of the US economy, but a high beta play on the US economy. So it responds more quickly to underlying economic conditions. So I can understand why people are concerned, particularly when you look at those forward orders and things like that go and sort of give you some sense as to what activity might go and do in the future. Jobless claims as well, continuing to drift higher, can be volatile week to week, particularly in summer months. So again, the signal is there that the labour market is softening, but do you go and take 1 week on merit and say, well, that's the start of a need for the Fed to go and slash rates and everything else? Well, I suggest no. I think what at the moment is lots of panicky selling. We're seeing a lot of opportunistic moves. And remember, we're less than 12 hours out from payrolls in the United States, probably the biggest volatility event that the markets have to go and deal with each and every month. So Friday, before payrolls, and people are panicking. Is it going to go and last long? Well, I don't think it is, because I'm just becoming on air. I was having a quick look at what was going on. And you look at things like the Aussie dollar against the US dollar, the Kiwi, some of the moves we'd seen off the lows in equity indices futures around the region. What did that correspond with? Well, we saw a big pickup in Asian equities when the Chinese markets opened off the lows. That to me is telling me that a lot of these moves are being exacerbated by the fact that a lot of people are sitting on the sidelines, waiting to see what happens tonight with that payrolls report before we go and throw the baby out of the bathwater. Just on some of the things here, let's go and kick off and have a quick look at what's going on in the rates universe, because that really is being influential at this point in time. Let's go and have a look at what's going on when it comes to the Fed funds futures curve 2024. So basically what the markets are looking for over the course of this year from the Fed. And you can see here, there we go. You can see here on your screen, this is basically looking at how many basis points worth of cuts are being priced in right now for the Fed this year. And you can see the big move over the past couple of days. Big move. Another full cut being priced into that curve for 2024. And really on the back of not a lot of new information, it's got to be said. Panicky. We're seeing in the markets right now that there's a 1 in 3 chance being priced in that the Fed will go and cut by 50. Again, is that really reflecting reality? A couple of days ago, Jerome Powell said it's not on the agenda. We're looking at some soft numbers out overnight in the United States, but certainly not to the kind of level that suggests that things are really killing over rapidly. Is the Fed going to panic and slash 50? Well, I'm still debating that one right now. Let's see what the payrolls report says, and let's see what the key ISM non-manufacturing PMI says next Monday, which covers a far greater part of the US economy. Looking further out over the next month or so when it comes to expectations for rate cuts, we can see the markets piling them on right now. So this is the curve between June of this year and June of 2025. And right now, we've surpassed 6 full cuts. We're actually moving towards 7 cuts being priced over the next year or so. When I go and look at this, it reminds me very much of what we saw back in December of last year when the Fed pivoted towards rate cuts. But the key difference on this occasion is that when the Fed moved back then, that was when the labour market was still very strong in the United States. And then we saw that pick up in inflationary pressures again to go and kick off the year. The US economy remained very resilient, and the market was forced to go and curtail the amount of cuts that were in the other profile over the course of the year. But now the difference is the labour market is starting to go and soften. And if it really, really deteriorates, well, the risk won't be on this occasion. We see markets have to curtail those dovish bets. It'll be the other direction. And similar to what we've seen in other cycles where the Fed tries to go and deliver a soft landing, but unfortunately it delivers a hard landing. So it's first slash and burn as the economy really falls over. So that's going to be the risk on this occasion. But again, we're not at that point. I know the markets are getting panicky about it, but let's go and see what the key data over the next couple of sessions has to go and say. Look, when it comes to the flow-on effects around, there'll be some big shifts as well in other curves. Looking across what's going on in Australia as well, I was looking just before 3-year yields. Now, currently sitting around 6-8%. That's the lowest level seen in a long time, going back to April of this year, of course, when the market started to go and bet on RBA rate cuts coming through. Let's go and look at payrolls tonight because it's going to be really influential on sentiment. Now, there's lots of views being put on social media and the like about what's the best outcome for risk and what's the worst outcome for risk. Well, to me, I know that a weak number would likely be the worst outcome, in my opinion, because we already have markets concerned about a hard landing and the Fed being behind the curve. Now, whilst a weak reading would go and see the Fed likely go and move and slash aggressively when it comes to the rates, if that's happening, the recession is already here. It's already started, and we know from economic history that that typically means that very bad news for cyclical assets, very bad news for corporate earnings, and the like. To me, if you get like a number where it comes in reasonable, not too hot, to go and make deter the Fed from potentially moving as soon as September, that to me is going to be okay. Really comes down to what in particular the unemployment rate is. That's the one that I'm going to be looking at the most carefully. That's the one that's going to give us a sense to what's going on in the broader labour market. Payrolls numbers month to month are too volatile, and the markets have become really accustomed to that number beating expectations. I can see here at the moment, looking on the screen, I'm going to get there eventually. Sorry for the lagginess here of the internet. But you can see here, markets are looking for 175,000 increase in payrolls over the course of July, down from 206,000. Now you can pretty much go and assess that the markets expect that there's going to be probably north of 190 odd thousand, maybe even 200,000 based on what we've seen in the past. We know there's been a tendency to go and beat to the top side with revisions to latter data. So keep a close eye out for that. If we go and get a number which actually undershoots on payrolls, that's the only thing that I'll be really attuned to when it comes to that particular measure, because that again would go and signal that we've got a hard landing already underway. So that's the two numbers we're paying attention to now. Earnings are expected to go and grow 0.3% over the course of the month, average hourly earnings. I'm not so concerned about that particular metric nowadays. It's really coming down to activity and what's going on in the labour market. It's going to go and drive things, not so much the potential that we're going to see a re-acceleration in inflation from wage pressures. That's certainly not the base case scenario at this point of time. Other things to go and look out for as well. Underemployment doesn't get a lot of attention, but that's another measure of labour market slack. And keep a close eye on the household survey as well, rather than the actual payrolls, because that's been giving a really much weaker assessment on the US economy than what we've been seeing elsewhere of late. If that really starts to go and decline, and we see a lot of temporary jobs being slashed as well, we know that, again, that's a pretty negative indicator. Of course, if it's the opposite, things are going okay, and that might go and help appease things. If we see that the data continues to go and hold up okay, dispelling those concerns about a hard landing, I think markets net might go and recover some of the gains that we've seen recently. On the RBA next week, I know that a lot of excitement this week with that trim mean reading coming in at 0.8% for the quarter, which is still very hot and still won't get inflation back to the RBA's target. But that to me was enough to go and dispel any chance that we're seeing a rate hike coming through from the RBA. Now, it just comes down to when we see cuts taking place. And when I look at what the RBA is likely to go and say on this occasion, I think it's going to be pretty obvious that they'll probably maintain the view that not ruling anything in or out, but we know that probably pay really close attention to what they say about the external offshore economy and everything else, the global economy, because that I think is going to be the area. If the RBA is going to go and cut really early this year, which is not my base case scenario right now, but if it is, it's almost certainly going to come from external factors, not what's going on in the domestic economy. So at this point in time, the markets are getting pretty aggressive when it comes to the degree of rate cuts from the RBA. It really comes down to what goes on in the global economy and how the RBA sees that. So we'll see what they signal next week, but I'm certainly not expecting them to go and signal a dovish shift like we've seen from other central banks, despite that slight undershoot when it came to our trim to mean measure. Indeed, it was actually on a year-on-year basis more than what they were forecasting just a couple of months ago, and much higher than what they were expecting earlier this year. Want to go and look at some of the moves in currency markets in particular as well. And I want to kick off with what's going on in dollar yen, because that to me has been not just the really dominating FX markets, but it's also dominating more broadly markets, particularly when it comes to a sentiment as to what's going on. And this chart here just goes and tells you what's driving dollar yen at this point in time. Now, we know that for a long period of the time this year, there's lots of optimism about the carry trade, using the weak yen, low yielding yen to go and swap into higher yielding currencies in riskier assets and the like. See here that rate differentials have now really reasserted, and particularly what's happening at the front end of curves, which basically tells me that what's going on is that the markets are paying really close attention to relative interest rate outlooks between Japan and the rest of the world. So you can see here expectations for Fed rate cuts over the course of the next 12 months, sitting with a rolling correlation over the past month at 0.8. Look at the 2-year yield spread between the United States and Japan, 0.95, so nearly moving in lockstep. And the further out the curves you go, the slightly less of the correlation, but still very strong. You can see here with 5 years, 0.91, and with 10 years, 0.75. You can see here, still, as you'd expect, very, very strongly correlated with risk assets at the moment as well. See that? The NASDAQ futures, and you can see there sitting at 0.89. So it's a combination of what's going on when it comes to Fed rate expectations in particular, and how risk assets are performing at the moment. They are the things that are really dictating what's going on in dollar yen. So I'm going to go and look at this chart. This is a weekly chart of dollar yen, and it just really helps to go and eliminate a lot of the noise that we're seeing out there at the moment. And after breaking this uptrend that pretty much kicked off the start of the year, when the Fed was forced to backtrack on its expectations for earlier easing of interest rates, and the markets were followed suit. You can see here, once it's broken that, it's just been straight through. And then the thing that would probably be really concerning in my book for bulls is just how easy the price has smashed straight through this really level around about 152, which we'd seen for a long period of time had cap gains over the course of recent years. And when it finally broke, we saw the big move, including having to see the BOJ intervene on behalf of the Ministry of Finance. Now that that's gone, we're now seeing that January 2023 uptrend. So to me, that is really, really important. That has to hold. I'm talking about 146.50 would likely be cannon fodder, and you can imagine that looking at the chart, it comes down to this area here, 130. The price did lots of work either side of that back in 2022 and 2023. And you can see here that if it was this to break, this is the zone that you'd be probably targeting as a trader. This uptrend, look, I don't really like the trend, but it just gives you a sense here as to where we've come from based over the course of the pandemic. So early stages of that, the dollar really starting to pick up as the market's priced in Fed rate hikes, I should say. And you can see here that that's in the line, just to keep a close eye on in the future. Aussie dollar, I know many of you are sitting in around Australia at the moment, looking at what's going on. Look, it's been really messy price action, if I'm being honest at this point in time. But clearly it's a sell and rally play at the moment. As risk off takes place across other markets as well, you can see here that it's not really fed very well. Also being dragged along by what's going on with dollar yen and the like. Which you can see here, the correlation with dollar yen over the course of the past month or so, sitting at 0.9. So again, quite strong at that point. One key area to go keep it close. Don't get too pessimistic now, because this is an uptrend that dates back to the start of the pandemic. And when it bounced off it, threatened to go and break, and then look down here back in April of this year, break through it and then snap straight back higher, and then you can see what happens. So that to me is going to be a really key area to go and watch here. So around about 64, 65, because it's where this section intersects with a horizontal support at that particular. So to me, that's really important to go and keep a close eye on at the moment. Let's look at some of the moves in equity futures, because to me, when you talk about the hard landing narrative and all the things we're seeing at the moment, the price action really is explained a lot by what's going on in these markets. Have a quick look here. We'll kick off with, say, maybe what's going on in SPOOs, E-minis in the States. Lots and lots of pessimism. Waiting for the technicals to go and load up there. Sorry about the lag here. So yeah, everyone's talking about the price action. So you can see here that former uptrend channel tested, and then big reversal back through the 50-day moving average. And look where it's now sitting for the first time, pretty much in the cycle where this trend line began. I think that's in January of 2023. We've actually fallen below that. So to say that today's session and the reaction to payrolls tonight is important is probably an understatement. You can see here where the market gapped early is now where it's sitting at the moment. So it's kind of just teetering at this level. If we don't see a big risk off reaction to payrolls tonight, that's going to be pretty detrimental, you would imagine. Very similar when you know what's going on with NASDAQ. Again, the price action, a lot of it explains the narratives that we're hearing right now. See here, around about 19,000 has been a pretty important level. Did some work there earlier this year. And then here we had bear trap, big reversal following the Fed, but back to 50-day moving average, which we have seen the index has gone and respected plenty of times over the recent times. And you see it rejected at that level, straight back down. You can see here now we're sitting around those lows again, waiting to see how things happen tonight on the back of big volumes as well. So clearly, to me, as long as it stays below that 50-day moving average, it's a sell on rallies play, definitely not buy on dips at this point. It just feels like the market is heavy and it's going to take a big turnaround and send it towards the economy to go and change things up. Very similar when you look at Russell, small caps got very excited about the prospect of rate cuts and Donald Trump taking the presidency, which now looks, according to betting markets at least, less likely than just a few weeks ago. And the price action that we've seen recently, so post-Fed, breakout, looked fantastic, but then look, reversal, shooting star, and then big bearish downward candle. And you can see here, now sitting around the levels that we saw back earlier this month, or in July, I should say. So that's kind of where you'd be looking for right now. But to me, it's looking vulnerable. Looking at the MACD, looking at RSI, both giving negative signals at this point of time. Let's have a look at the ASX as well, because that's one that has been really interesting. And again, the price action, the signals that we're seeing at the moment, they explain a lot of what's going on. You can see here, breaking higher following that CPI report, and then break to record highs, and then come back down, shooting star, and then you want to go for the three count, and that there, evening star. So looking at that, and that's just warning of downside risk. How much downside are we going to see? Well, we can see that the market's got a fixation with the 50-day moving average at the moment. Every time it goes down there recently, it's been either supported or not remained there very, very long. So to me, that'll be the first port of call. You can see here, down to around about 7614 is another area. If you look here, there's also been a lot of buying that's taken place from 7685. So dips below that have been bought going back to the early parts of June. Bit to go and take in there, obviously. I guess actually I'm going to go touch on, given some of the events in the Middle East as well. And a lot of people it's difficult to go and ascertain exactly how to go and read crude right now, because on one hand, you've got the potential for major disruptions to supply from the Middle East, including something involving the Red Sea, which is really, really bad, as you'd imagine. You've also got the narrative that things are falling over economically around the world, which would be really, really bad for demand. So that's kind of like explaining some of the stuff we're seeing. That's the narrative at least. Well, the price action is actually pretty instructive as well. Here we are, day moving average. Big rally over the course following the Fed, weaker dollar and the like, and then rejected the average and back lower. It's difficult. Geopolitics is really, really difficult to go and try and read how it's going to play out. But from a price action perspective, as long as it's below the 2-day moving average, I prefer to go and sell on rallies rather than buy on dips. When you look at some of the momentum indicators, RSI is continuing to go and trend lower. It's a couple of sessions ago, did manage to go and break through that downtrend. At this point as well, MACD is just sitting there. It's not really giving me too much of a signal one way or another, but this here, RSI is just saying me that momentum for the moment is still building to the downside. So keep that in mind. When it comes to some of the other levels as well, you can see here just above 74 is where the market bottom. That will be the first port of call if you want to get short, and then below that 72.50 on the top of the 200-day moving average. 50-day moving average hasn't been respected anywhere near as much as recently, but have a look at 80-30. Lots of work on of recent months. So that would be if we see a reversal, it would be some kind of escalation in the conflict. Would be a good pair that breaks. Then of course we start talking about moving back towards the highs that we saw in April earlier. Look, quite a bit to go. First, just want to go and as Simon, just letting you know that at the moment, while things are looking pretty negative out there, and I know that there are people who are concerned about what's going on, don't panic in this scenario, because panic selling is where you typically go and really go and manage to go and sell low and buy the highs at the other end of the other spectrum when it comes to investor emotions. Wait to see what the data has to go and say over the course of the next 24 hours. What we're talking about right now could be completely different. And just to reinforce the point from what we've been talking about, particularly with the equity indices and the price action to me is the thing that is directing the narrative, not the other way around. So keep a close eye on that and let that go and dictate how you're going to perform, rather than listen to what people in media and the like are going to assess to what is going on at this point in time. Anyway, fantastic. Thanks so much for joining us today. And now, if anyone's got any questions, I'll go and put that up. And whilst I do that, quick look at the disclaimer to go and see, make sure that any advice that I give here, of course, it looks like internet connection here on a Friday. Thanks for those who joined me today, and best of luck with the trade over the course of the next sessions. And hopefully that goes